Let's go back to Mike and Peggy. They have decided that a partnership is not the best way to organize, and they decide to incorporate. They want to attempt incorporating over the internet, and they do an online search using the phrase incorporate online. Mike and Peggy get several hundred matches, promising them incorporation at rates that range from $79 to several $1,000s. Many websites want them to incorporate in the state of Delaware or the state of Nevada because those states have favorable tax laws. Mike and Peggy decide that because they're so new to this incorporation idea, they would feel much safer using a local attorney. They talk to several attorneys and find one who agrees to do the incorporation for $800. That includes all legal fees, document preparation, and state filings. The first thing the attorney does is a name search to make sure that the corporation name isn't already being used in their state. Mike and Peggy wanted to use A1 Landscaping, but there's already a corporation operating with that name. The attorney suggests they use A1 Land and Lawns, which pleases Mike and Peggy because it'll give them better Yellow Pages placement. The attorney drafts a certificate of incorporation, which is filed with the State Division of Commercial Recording in their state's capital. The attorney also prepares a document called the Corporate Bylaws, which the state requires as part of the incorporation process. Corporate bylaws list nuts and bolts information, such as the office location, date of annual meetings, and how shares are distributed. The corporation has its first meeting of the board of directors at the attorney's office, where all the documents are filled out and signed by Mike and Peggy. Mike and Peggy are really happy with their new corporation because they're going to buy their health insurance, their life insurance, and their disability insurance through the corporation with tax-free money. The money is tax-free because the corporation is going to pay the premiums and deduct the cost as an expense. When they were sole proprietors, Mike and Peggy had to pay their premiums through their personal accounts. The company that Mike and Peggy have set up is called a C Corporation. This is the form of corporate ownership that most large companies use. Mike and Peggy go to meet with an accountant to set up a bookkeeping system. This is their plan. They're going to each collect a salary of $40,000 a year. That will be through a paycheck which will have income tax, Social Security, and other payroll deductions taken out of it. They calculate they will have an $80,000 profit left over at the end of the year. They plan to take that $80,000 as a dividend. Although you must pay income tax on the dividend, it is not subject to Social Security tax. But the accountant tells them something else they didn't know. That $80,000 will be a corporate profit, and it will be subject to corporate taxes. So now Mike and Peggy are going to pay a high corporate income tax rate on the $80,000 profit. That leaves them about $60,000 for their dividend. Then, after they take that money for themselves, they are going to pay personal income tax on it again. In other words, that profit is going to be taxed twice. The accountant tells Mike and Peggy about a different kind of corporate structure they can set up called an S Corporation. By setting up as an S Corporation, they can avoid the double taxation. To become an S Corporation, all they need to do is file a special form with the IRS. The S Corporation has several requirements that differ from a C Corporation. The S Corporation can only have up to 35 shareholders. The S Corporation is treated like a partnership for tax purposes. Profits pass through the S Corporation directly to the owners and are taxable at the owner's tax rate instead of at the higher corporate tax rate. The biggest downfall for Mike and Peggy with the S Corporation is that their medical insurance premiums are no longer tax deductible. They do some more calculations and figure that the savings from the double taxation is more valuable than the tax savings on the insurance premiums. They fill out the form and become an S corporation. In many cases, the story could end here, but Mike and Peggy run into another problem: the paperwork. They have to do monthly payroll reports, quarterly payroll reports, quarterly income tax returns, unemployment, disability, and workers' comp returns. They've got so much paperwork to do, they start wondering, why did they ever decide to incorporate? All they wanted to do was run a business, make some money, have some protection from getting sued, and live a normal life. Then one day, Mike and Peggy learn about another type of company they can set up, the limited liability company. A limited liability company, or LLC, offers the simplicity of a sole proprietorship with the protection of a corporation. Like a corporation, the limited liability company protects the owners from debts and lawsuits incurred by the business. And like a sole proprietorship or partnership, business income is reported on the owner's individual income tax. Because the income is carried through to the owner's personal tax return, profits earned by a limited liability corporation are not subject to double taxation the way a C corporation is. Mike and Peggy like the liability protection the LLC provides, and they also like the simplicity it offers in tax reporting. So they decide to form an LLC. A quick internet search finds many inexpensive professional service companies that are willing to help Mike and Peggy form their new company. While the appeal of saving hundreds of dollars in legal fees is enticing, they decide to play it safe and go back to the attorney who helped them set up their corporation earlier in our story. When they meet with their attorney, Mike and Peggy find out they don't have to start up a new company. There's a way they can convert their existing corporation into an LLC. Setting up their LLC involves creating a legal document called an operating agreement, which their attorney takes care of. They apply for a new tax identification number from the IRS, following the same process they used getting a tax number for their corporation. In a matter of a few days, A1 Land and Lawns LLC is in business. Mike and Peggy have a great head start since they've been in business in their individual enterprises for many years. They already have customers. For most entrepreneurs, forming the business is just the start of a long process.